What if everything we thought we knew about tariffs is backwards? It started with a promise to put America first. But what followed was a high-stakes trade war, one that left global supply chains rattled, allies alienated, and some industries celebrating, while others were forced to their knees. So here's the big question: who actually loses the most under Trump's sweeping tariff policies? And is anyone really winning? Do you think the tariffs are helping or hurting the U.S. in the long run? Yes or no? Let us know your take in the comments. The stakes couldn't be higher, because what's locked inside this web of economic reshuffling could reshape more than just trade. It could redefine global alliances, push inflation higher, or even trigger the next recession. In this deep dive by Endgame Compass, we're going to unpack the winners, the losers, and the hidden dynamics shaping the next era of global trade. Stay with us, because the last section of this story might change how you view globalization itself. Let's set the stage. Washington, D.C., amid growing dissatisfaction with long-standing trade deals, President Donald Trump launched a bold campaign to remake the global economic order. These weren't just tweaks. They were seismic shifts in the form of sweeping tariffs. The administration claimed these moves were meant to protect American industries, offset the fiscal gap created by congressional tax cuts, and bring in foreign investment that would ultimately create jobs back home. But here's where the contradiction kicks in. While they hailed tariffs as a strategic tool, early signs showed something more: troubling shocks to the U.S. economy itself and increasing friction with close allies like the EU and Japan. Despite those warnings, Trump's White House saw every concession by foreign powers as validation, pointing to empty retaliation and preliminary trade deals as success benchmarks. But the higher tariffs implemented just after midnight on August 7th marked a return to levels the U.S. hasn't seen since the 1930s. During the infamous Smoot-Hawley-era policy, many blame for worsening the Great Depression. And according to Bloomberg Economics, the numbers don't lie. These tariffs will raise the average U.S. rate to 15.2%, compared to just 2.3% in 2024. The blow: an estimated $2 trillion removed from global GDP by 2027. That's not just an economic slowdown. It's a reordering of the global marketplace. Now, let's break down the battlefield. The U.S.-China trade war may be in temporary truce, but Washington is still slapping a hefty 30% surcharge on most Chinese goods. Meanwhile, imports from Britain and Singapore get off relatively lightly, facing only a 10% duty. Countries like the EU and Japan are just a touch above that at 15%, but the deeper you dig, the more extreme it gets. Swiss exports, including high-end goods like watches and chocolate, now face tariffs as high as 39%. And here's where it stings. India, a longtime U.S. trading partner, is sitting under a 25% reciprocal tariff. But if an additional 25% penalty hits in retaliation for buying Russian oil, the total tariff could jump to 50%, effectively pricing many Indian exports out of the U.S. market altogether. Brazil finds itself in the crosshairs too, with potential duties approaching that same brutal 50% level. So we see the pattern forming. It's more than trade. It's geopolitics, leverage, and retaliation woven into a higher-esque economic experiment. But here comes the twist. Even as this new tariff wall rises, the U.S. has quietly built doors into it. You wouldn't expect it, but over $1 trillion worth of goods were actually exempt from the new wave of tariffs. That's more than a third of all U.S. imports as of 2024. How? Largely opaque system of exemptions and negotiated special deals. Major industries and large corporations with the lobbying power to match up secured tariff relief. While most businesses brace for impact, the powerful few are making quiet gains. In April, Trump signed an executive order with a 37-page annex listing over 1,000 tariff codes each, one carved out as an exception, and companies like Apple, they didn't just avoid tariffs on iPhones and laptops. After committing to invest $600 billion in the U.S., Apple scored even broader exclusions, circumventing future tariffs on semiconductor imports too. Samsung appeared to follow a similar trajectory together. This tech sector alone dodged over $7 billion in tariffs across just 2 months. So, are tariffs about protecting workers or protecting power? Let's talk about the countries and sectors shouldering the heaviest burden. India sits near the top of that list. Quote, with its exports targeted by a 25% reciprocal tariff, and with Trump threatening to double that as punishment for buying Russian oil. Indian exports to the U.S. could drop by as much as 60%. That's not speculation. Bloomberg estimates it could knock nearly 1% off India's GDP. Switzerland is another casualty. While key exports like pharmaceuticals and gold remain exempt, most of its major exports now face a suffocating 39% tariff, far higher than neighboring EU countries. And what about domestic blowback? Since the launch of these trade policies in April, the U.S. hasn't seen a manufacturing renaissance. In fact, it's lost 37,000 manufacturing jobs. That's despite the administration's claim that tariffs would steer capital and factories back to American soil. Big industries are warning of the price. General Motors took a $1.1 billion hit. Ford's on track to lose $2 billion in 2025. Toyota projects nearly $10 billion in annual tariff costs. This isn't just theory. It's already on the balance sheets. Now, this part's simple and surprising to some. Trump has repeatedly touted the surge in tariff revenue, nearly $30 billion per month, as a win for the U.S. Treasury. But here's the reality. Tariffs are taxes. By law, they're paid by U.S. importers, not foreign governments. In most cases, those costs are passed directly to consumers through higher prices. So that cheap appliance, that car part, that bag of imported coffee, it's now more expensive. Not because of inflation, but because of tariff costs embedded in the supply chain. In short, the American consumer foots the bill. And while Trump argues that foreign exporters will eventually absorb the pain by dropping their prices or adjusting currencies, economists say there's little evidence of that actually happening. If you're still watching, then you're here for insight that goes beyond the surface. Make sure to click that subscribe button and turn on bell notifications. At Endgame Compass, we break down the global power plays that shape your financial future, from trade shocks to currency shifts. This might be the biggest twist of them all. At first glance, China appears to be a major loser. Exports to the U.S. have indeed slumped. But the bigger picture? China is rapidly diversifying its markets, strengthening ties with emerging economies and Eurasian trade partners. And as Trump escalates trade tensions, some U.S. allies are beginning to see Beijing as the more stable and reliable alternative. The fact that U.S. factories now face higher input costs, and you have a paradox. Trump's tariffs, meant to restore American manufacturing, may actually be making it less competitive internationally. And as relations with foreign buyers sour from Canadian boycotts to Indian outrage, the long-term outlook becomes even murkier. The policy path isn't ending. Trump has pledged to introduce fresh tariffs on pharmaceuticals and semiconductors, potentially as high as 250% and 100%, respectively. Carve-outs are likely, especially for companies like Apple that can promise U.S. investment. But that's not all. New investigations are underway for sectors like drones, commercial aircraft, trucks, critical minerals, and lumber. Any of these could result in another round of tariff sand, another wave of ripple effects. Trade negotiations may continue. Switzerland is lobbying for relief from its 39% burden. India, under pressure for its oil ties to Russia, may reach a settlement as a bargaining chip. But the wild card now is the U.S. economy. Wall Street is already flashing warnings about a possible market correction. And if this trade-driven strategy starts pushing America toward a slowdown, or even a recession, recalculations could be inevitable. So who wins in all of this? Some corporations, especially in tech, have figured out how to navigate these rules to their benefit. But there are no absolute winners. Not really. China loses U.S. market access, but gains influence elsewhere. The U.S. flexes on policy, but risks inflation, job losses, and weakening global trust. More profoundly, a trade war with shaky logic often leads to mutual damage, while third parties explore their chance to grow. So we leave you with this. Are these tariffs reshaping the global order or unraveling it? I want to hear your take. Are these tariffs a masterstroke of strategy or an economic ticking time bomb? Drop your thoughts in the comments. We read every one. If you gain value from this breakdown, don't just subscribe to Endgame Compass and hit the bell. Because in times like these, timing matters more than ever. This is where deep analysis meets global strategy. Stay curious. Stay informed. Endgame Compass, signing off.